All right, I guess we can get started now. Welcome everybody to another edition of Crypto World Radio. I am your host, King Wabi, and today we are joined by Entangle Protocol and the Entangle Protocol team. We have the founder, and we also have Trishy, who's the CMO, and we also have one of the guys from the dev side of things. And so this space is going to be recorded here on Twitter Spaces, and in a couple of hours it'll be uploaded onto our YouTube, and you can find all of our previous spaces on the Crypto World Radio playlist. And if you guys have any statements or questions towards the end of the space, feel free to do so. And first and foremost, I want to thank the Entangle team for taking the time out of their day to come and talk some shop here in our spaces. I really love what they're building. I'm a huge fan of Layer Zero tech, and so without further ado, I guess we'll get started off with Faisal. How are you doing today, my man? Good to have you up here.
I'm doing great, thank you. How are you, King Wabi?
I'm doing great, man. I'm doing great. Tristy, how are you doing today, brother?
Couldn't be better. Always good to be here on the spaces.
Awesome, man. Yeah, man. I really like what Spaces can do. You have a one-on-one interaction with really anybody from the crypto industry. So we'll get started now. So I guess the first question that I have is, what is Entangle Protocol, and what are you guys seeking to do within Web3 and crypto?
That's a great question. So before I start, thank you for all the guests that have turned up today to hear us speak. So really appreciate your time. So with Entangle, I think what the best way to describe it is we're looking to resolve liquidity, both from a liquidity optimization perspective and a capital efficiency problem. So Entangle is its own sublayer with a dedicated, customized Oracle solution to allow cross-chain liquidity and data transmission. And alongside it, we're building our own DAPP, which is really to unify liquidity and solve the fragmentation of liquidity. And the DAPP allows any yield asset to be synthesized to a liquid stake derivative, which can then be utilized for secondary and tertiary DeFi use cases. So as an example, if you're an LP to Trader Joe on AVAX, currently you're only providing, currently you're only receiving an LP token, and that's where the story ends. But with Entangle, you can synthesize that to a liquid stake derivative equivalent, which is backed by the real LP on Trader Joe on AVAX. And then you can provide this LSD for further yield to lending and borrowing solutions, potentially option protocols, and other types of DeFi yield-bearing protocols, which then essentially empowers the user with far more greater capital efficiency and dual earning potential.
Awesome, man. So going back to what we were talking about with Layer Zeros, how do you guys differ from other omni-chain protocols like Layer Zero itself? And also, what use cases does Entangle allow for as well?
So those are great questions. So on the call, you have my co-founder Slava. I think he'll be very, very happy to talk about what the differentiators are between us and the said competitors. So Slava, I'll let you take this one if you want.
Yes, a great question. I assume you refer to our Oracle solution. Just to go back on what is Layer Zero exactly, it is a mechanism that is essentially a layer on top of Chainlink or any other distributed Oracle solution, which is validated off-chain and connects to endpoints, to blockchain endpoints. Excuse me. The differentiator between Layer Zero and Entangle is that at Entangle, we verify and do on-chain computation and store data on Entangle blockchain, whereas Layer Zero, it is built upon Chainlink, and also excuse my cough. In layer 0, you have customizability of keepers and relayers as they are pinpointed. You can essentially choose Chainlink or any other and choose your own relayer. And I think in that way, it's very similar to Entangle, as we allow full customizability of keepers. But before I go there, maybe I will just give a brief background on how the Entangle Oracle solution works exactly. So keepers, Entangle keepers download information via RPC endpoints for on-chain information or API for off-chain into Entangle blockchain. There we store the information, we do on-chain computation and process that information and validate it. And if there's an event execution that needs to happen on any other blockchain or multiple blockchains at once, then we have keepers aggregating them to the destination endpoint on any other blockchain. And now in this destination endpoint, we will have a threshold consensus validation, which means that we have multiple of keepers aggregating information, which is then compared at the destination endpoint before this is executed to a smart contract to do smart contract automation.
Awesome, man. So I'll follow that up with what Faisal was saying. Maybe Tracy, if you can go into detail with this. So could you explain how the liquid staking derivatives and like the XLSD work, and how they would allow users to earn cross-chain liquidity rewards and also borrow stable coins simultaneously?
Yeah, so I think coming from a TradFi investment banking background and being in crypto for over 5 years, it's been a great experience for me to sort of dual visualize both industries. And I think the whole purpose of DeFi really is to allow privileged, what you would deem as for privileged investors or high net worth investors, products and access, which is only available to them in TradFi. So one of these, and DeFi really opens up the doors for exotic use cases for a multitude of users, be it the DeFi beginners or the DeFi degens. So yeah, in terms of how it would work or what the use cases are, so an LSD is basically like a ghost token or a synthetic token where you back your collateral into a locked contract, and then you get a receipt token, i.e., a synthetic token like a liquid stake derivative token. And this is essentially saying or telling others that behind me is locked collateral in a smart contract, which you have rights over. If you take the LSD as collateral and you borrow me US dollar against it or whatever the currency may be, if I fail to perform on my obligations, then you're able to liquidate my original collateral. So based on this, you kind of expand the utility of collateral. So as the example that I gave very, very early was on Trader Joe, if you have an LP, so if you're providing liquidity to a DEX, and liquidity is the lifeblood of all of DeFi and actually all of any business really. So currently you provide liquidity in the form of, for example, USDC, USDT. That liquidity is obviously used and that's what the DEX functions on. But currently, and as a user, you get this LP token, which really is a receipt for your deposit, but there's no utility around that. So what Entangle does is it locks your LP token in a smart contract where auto compounders are run. So it's auto compounding, which produces a price change every so often. Because in DeFi, as you know, you would compound your rewards, sell your rewards, go back into the pool. So that's already being done on an automatic basis. But what that creates is a price update, which then is reflected on your liquid stake derivative. So you lock your LP, your LP is locked in a smart contract, you get an LSD. That LP, original LP, doesn't move now, it's locked. And your LSD is like your key to unlocking that. So, and then you can go to another protocol and say, okay, well, I've got, for example, for figures as an example, I've got $10,000 locked in a smart contract, or my LP is backed by $10,000 worth of USDT, USDC in a smart contract. I want to lend 3,000 or 5,000, whatever it may be in terms of loan to value. And then obviously, if I don't perform on my obligations on that loan, if I don't return it, or for whatever reason, the borrowing entity needs to liquidate to cover the loan, they're able to do that because they can basically liquidate the contract with the LP and subsequently have access to the US dollar that's underlying the original LP. So what it does is it allows really liquidity to be recycled throughout the ecosystem, because crypto is it's relatively a very small liquidity ecosystem in terms of AUM. I think crypto's total market capitalization, is 1.3 trillion at the moment. And I think some of the really big FANG stocks are probably slightly larger than that, or in that ballpark figure. So we really looked at this not only from a fragmentation perspective, but also the fact that there needs to be real utility, and most importantly, optimization. Because if an Entangle, once it achieves this, it actually kind of resolves two problems in one. One is that it resolves a capital efficiency problem for the user. The user now has more options on their yield-bearing assets, and from a protocol perspective, you are really increasing your chances of liquidity retention, because if your users have more options available on their LPs, the more likelihood is, if I'm earning and earning, or if I can earn and borrow at the same time, I wouldn't want to move my initial liquidity. So it increases the probability of liquidity retention. So yeah, apologies for the long-winded explanation, but I hope that makes sense.
Yeah, man. So one thing that I wanted to touch upon with everything that you had stated, I understand that you guys have a pretty interesting oracle going on with what you guys are building. So would you guys be able to explain how the distributed oracle solutions and also the chain itself, as far as the potential that it has to not only scale DeFi protocols, but also increase liquidity across chains and also promote protocol stability?
Yeah, so go ahead, Slava.
No, it's fine. Just go ahead, Faisal. I'll just double in if there's anything.
Yeah, I think I'll just give a bit of background, Slava, and then you can obviously add to it. The Oracle solution was really designed to satisfy our own needs and requirements as a protocol. The initial idea and the real core idea was the synthetic vaults DAPP, but it just transpired that we needed the Oracle to fulfill technically what we needed it to do. So how DApps can scale cross-chain, it just transpires that our Oracle solution, due to the way it's constructed, really allows any DApp to scale cross-chain. And this really builds very exciting possibilities for the future. And as Entangle is building, so if you look at blockchain or crypto in particular, it's drops of liquidity everywhere. So everything was built in silos, in a siloed mindset, with layer ones being built in silo. So if you imagine layer ones as the plot of land, and then you have the dApps that were then built in silo with motivations really to quickly launch a project, launch the token, bootstrap some liquidity, and then see and hope for the best in majority of the cases. So what that really led to is a siloed ecosystem. So with Entangle, what we're looking to do is allowing other dApps to come in, utilize the Oracle solution to scale cross-chain and to communicate with other layer ones and other DApps, or alternatively just simply open up their offering to users from multiple different ecosystems. How that integration works and technical details, I'm sure Slava can speak about that all night, but just very at a high level, I hope that answers your question.
Just maybe also to dive deeper into really why we built our Oracle solution. And I think maybe the general question is, why didn't you guys just use Chainlink or Layer Zero, right? I think those are maybe the most straightforward questions. We didn't use them just because it wasn't possible to use them for what we need to do. Because we have a cross-chain DApp, which is on 8 chains, and sometimes we need to automate smart contracts on 2 or more chains at the same time, which each have interdependencies on their own. And CCIP on Chainlink is not live yet, so it's just impossible. And Layer Zero is essentially just a pairwise messaging protocol. It doesn't really allow you to message many blockchains at the same time. But really, it was about having that central database, which an Entangle blockchain, where we could store, process, and validate data and tap into that. So, for example, we can call any data on the Entangle blockchain from any smart contract on any chain, really, through our own external endpoints. But just a little bit more in that, I think right now, in the market, there are some new players coming out, such as derivatives protocols, options protocols, but I think mostly like futures, I would say, perpetuals. And they're realizing more and more that guys, we need to make an on-chain order book, but they want to do it on a highly specialized sharded chain, such as, for example, on an AVAX subnet or a Polygon supernet. But they often have problems because it's not exactly always the truth that Layer Zero has integrated them yet, or Chainlink. And with our integration, it's very seamless. We can integrate any EVM chain in a matter of days, really, to our Oracle solution. And what we also can offer and want to offer as soon as we go on testnet and closer to mainnet is essentially building these secure solutions, secure bridging solutions of liquidity for those new perpetuals protocols that want to launch on these supernet, to give them the possibility to do true on-chain order books.
So from a user perspective, right? Since Entangle is going to be accessing liquidity from a ton of native chains and all that, would the user even notice that they're even using Entangled?
I mean, let's just break it down, like to the points where the user is going to notice that they're using Entangle. So, as Faisal explained before, let's say you're an LP on Trader Joe and AVAX, you obtain an LP token from Trader Joe, and now you come to Entangle. Now you deposit the LP token, which is get auto-compounded by Entangle, and Entangle issues a synthetic vault. So that's one of the user interactions with Entangle. And then the second interaction is when you withdraw your LP token by depositing the synthetic vault in return. And then there's a third interaction with Entangle, which is if you want to bridge the synthetic vault to another chain because you think it's going to be high yield on a protocol there. And that's pretty much it. And there may be a fourth one where you can like stake it directly with Entangle. So like you can provide it easily through Entangle to a derivatives protocol, options protocol. But really, if you go, for example, to a lending and borrowing protocol, as we integrate those, and you put your synthetic vault as collateral there, it's really the protocol that's going to interact with Entangle on a backend basis and not the user. I hope that answers your question in detail.
Awesome, man. So I hear you guys talking about AVAX and things of that nature. So what other chains and protocols have you guys integrated with and will be integrating with. I also see that you guys have recently launched on Arbitrum, and lately we've had a multitude of Arbitrum projects hosted on these spaces. So really excited to hear what you guys have to say, man. And thank you so much for the descriptive answers, man. If you guys are enjoying the space, feel free to retweet it, and follow if you're enjoying this content.
Awesome. So yeah, I think so. We currently have a testnet live, which basically is connected to 8 different chains, including Arbitrum, Optimism, Ethereum, Phantom, Binance Smart Chain, Polygon, and a couple of others. So and we are planning to integrate Multiverse X, which is formerly known as Elrond, in the future. And the plan is to allow any chain to integrate and not have any barriers there. So we do foresee a massive business development campaign and co-marketing campaign moving forward, which Tristan will be very, very ably leading, and alongside Rod, who's not here at the moment, one of our BD colleagues. And just on that note, we've already partnered with a number of protocols. So we've partnered with Spooky Swap, Trader Joe. We got a grant from Aave, and also with Polygon. And we're in discussions with partnerships with QuickSwap, Stargate Finance, because a lot of these have already been integrated into our testnet. So there's a reason why we it was very arduous to do a testnet, because we had to fork a lot of protocols and the DEXs on the testnet versions. But we decided to do so, one, because it gave us the safety of testing what we're building comprehensively. And number two, it really opened up the doors to execute partnerships, not just on a badge exchange basis where, let's just exchange logos. It's really a deep level integration that's already there. So when we walk into a conversation and say, "Hi, Spooky Swap, how are you? We've already integrated you on our testnet. We're driving liquidity to you," or we're creating synthetic derivatives or liquid stake derivatives of your LPs. The conversation has a very different flavor to just approaching them without any technical plan. So we believe the effort was very much worth it for launching the testnet, which we're going to be launching V2. But yeah, to your question, we have 8 connected chains, and we foresee by launch to have at least 10 to 12, maybe more, on mainnet before launching, and then adding them subsequently as time goes on.
Awesome. And how far would you say mainnet launch would be, since you guys just said that you are currently working on version 2 of the testnet?
Yeah, so mainnet we have planned for Q3 of this year. We can't give a definitive yet, but it definitely will be within Q3. We're looking more than likely for middle of Q3 this year.
And for the Entangle token itself, what would be the utility of it?
So the Entangle token is one of those projects where there is actually a genuine requirement for a token, and it's not just there for the sake of liquidity bootstrapping. So one of the core use cases is the validation and the securing of transactions. So as we're running on Tendermint, Ethermint, proof of consensus, proof of stake, it's really required for validators to put down and delegators to delegate their stake to validators. It's also utilized to run Oracle Keeper nodes. So anyone who's involved with running the Oracle infrastructure will have to put down a stake. Furthermore, there's it's the gas fees on the Entangle blockchain, and then it will be used obviously to buy back, to reward emissions for the stakers of and delegators of Entangle token. But alongside that, not just with the token, there's a lot of Web3 protocols and projects. More so is changing now, but previously there's not been a real deep level sort of insight into revenue modeling. So with Entangle, we know that we have synthetic vault performance fees, we have Oracle revenue, we have liquidity recycling fees where if the LSD is used for collateralization, we obviously charge there as well as the middleware. And then later on, there are plans to have some sort of internal DEX where these synth LPs can be traded cross-chain. And those will carry their own fees. And those are then pooled into and distributed to liquidity providers, stakers, validators, Oracle keepers. And a small portion is then locked for future development. But all of these revenue distributions has one step before where the Entangle token is bought and then distributed to the relevant stakeholders as Entangle token. So it applies by pressure on the token from revenue that's being generated. And just one more thing, all of the revenue is real revenue. So we never emit Entangle tokens without there being tangible revenue behind that emission.
So the native DAPP built on top of Entangle, would that be a mixture of Synthetics Network and Thorchain, and also Synapse? If I'm correct on all of this, like if you were to sum it up, would this be the
It's
general
like
idea?
this. Yeah, it's like the Stargate of LSDs, I would say.
That's awesome, man. Wow. You guys are truly doing something amazing, man. So I know you and Trissy have to go relatively soon. So I want to
Yeah.
thank you two for hopping on the space. Slava, I'm not sure if you'd be able to stick around for like 10 or 15 more minutes, brother.
Yes, sure. It's my pleasure to stay on.
Yeah, thank you guys. Thank you, for hosting us, and thank you for the audience for attending as well. And we look forward to speaking to you very soon.
Thank you. Appreciate you guys. Everyone, feel free to
Take
follow
care.
Faisal and also Trissy. We'll be here for another like 10 to 15 minutes with Slava from the Entangle fight team. And yeah, if anyone here has any questions they'd like to ask, any statements, feel free to click that request button and come on up. We're here with Entangle. Truly an amazing opportunity. So yeah, and if you guys are enjoying this content, my name's Wabi. If you're new to this Twitter space, I host spaces with various founders, projects, devs, people from VC sometimes throughout the week here because Bitcoin. So if you enjoy this content, feel free to give us a follow and turn on bell notifications. And what's going on, Premise, bro? if you want to ask anything, feel free to do so, man.
Hey, what's good, man? I saw you sent me the invite, so I decided to come up. I'm just listening in, kind of, and doing some research. I'm actually going through the Entangled website and white paper right now. Currently, trying to educate myself a little while I listen in. I love to see new projects and people still building. Man, it's pretty good.
It's beautiful, man.
That's what we need to see.
Yeah. So Slava, would you be able to elaborate on how Entangle enables seamless cross-chain transactions for users, and how it helps avoid the risks and fees associated with actions such as bridging?
Are you specifically referring to the internal DEXs, or are you referring to the oracles? I'm not exactly sure. I concretely understand your question.
The DEX specifically, the DEXs.
Okay, so you're asking really how rebalancing works. So this is a dark hole, which I hope not to bore you too much with, but it's
fine. You can be as technical as possible, brother, because I know you guys are relatively new to spaces and things like that. So I want to take the opportunity to do as much of a deep dive as possible while we guys have you up on stage, man. So yeah, don't feel shy or anything like that to go into detail. Be as descriptive as you want, be as non-technical as you want. Stage is all yours, brother.
Okay, sure thing. So this internal DEX, just as an FYI, this is a very complex mechanism, and this is something we're gonna launch much later this year or next year, really. I think because right now we're just focused on taking existing LPs and making them into synthetic vaults because it's just so much easier of a go-to-market strategy that's just going to be much more logical for any DeFi degen out there. But still, I would love to discuss internal DEX rebalancing. This is a very complex mechanism that I have designed together with one of our core advisors, Ning, a PhD mathematician. So what we really seek to do is, I don't know, where are you based, King Mobby? In which country are you based right now?
I'm in the United States of America, brother.
Okay, that's kind of a bad example then, because I'm also in the U.S. right now. Anyone is in another country than the U.S. right now?
Let's just say I'm in Iceland. Let's give that example.
Okay. Let's say that you're in Iceland. I'm in the U.S. Let's say that you owe $1,000 to someone in the U.S. and I also have someone in Iceland which I owe $1,000 to. Now, rather than us doing cross-country or continent IBAN transactions, which take time, have a lot of fees, and ultimately depend on the bank, maybe we can just write off a contract and pay each other's fees, right? And this is essentially the core ethos behind internal DEX rebalancing. And I'll go a little bit deeper into that with some kind of technical stuff. So we're really doing that in order, for one, to provide some kind of immediate exit liquidity. So we minimize any event of bridging, and to allow for scalability, any existing pre-liquidity. So for internal DEXs to work, really, it assumes that you have some kind of pre-liquidity on each chain locked by pre-liquidity depositors or providers in USDC, which gets locked for 3, 6, or 12 months. They give that USDC to Entangle, and we give them rewards in return from trading fees there and also protocol fees. But we obtain LP tokens, which are pre-selected stable or mixed ones. For example, USDT/USDC, or for example, Bitcoin/ETH, that a mixed one. And now we that we have LP tokens, we issue synthetic vaults one-to-one based on the LP tokens. Now, we have 8 chains. So, for example, if we had liquidity providers on AVAX giving us USDC, we obtain AVAX Trader Joe LP tokens on AVAX. Now we now we mint synthetic vaults one-to-one, but divide the amount across 8 chains, because we can't ever mint more synthetic vaults than we are accountable for in collateral. So these are one-to-one backed. Now, users on any of those chains, they can go in and buy these or exchange them via USDC. And assuming that we're going to have a lot of different synthetic vault pairs and people are going to go in and out, we also need to be able to scale the liquidity, because what's the purpose of making something tradable based on initial liquidity providers if you're not able to scale it, right? Then, I mean, you're always just going to be bottlenecked by the liquidity providers, which is not a good solution in our opinion. But then the problem always comes, if you're going to scale, I mean, the most logical solution is, okay, you have a surplus of USDC, you bridge it over, maybe via Stargate to the other chain, get more LP tokens, mint more synthetic vaults on the other chains. Voila, right? But everyone knows, and maybe some of you have unfortunately been exposed to bridging hacks, that external bridges, even though they're getting much more secure and they're getting much more better, they're very, very frequent. And this is where internal DEX rebalancing goes in. So just like me being based in the US, and I think it was King Bobby that was based in Iceland. I didn't exactly get the name. And we sign up a contract and avoid cross-continent, cross-country IBAN transactions through banks. This is what we can do the same through the internal DEXs. We can look for close to equal demand of either USDC or synthetic vaults and balance that across in order to scale it and provide a certain portion of exit liquidity to the end user wanting to sell synthetic vaults. I hope that gave some kind of explanation. I mean, I can go into the math where we have the K, Q, and Z variable, but I'm that's a very dark hole to go into.
Yep, feel free to do so, man. You can get as technical as you want. Would love to get as much information on that as possible. But I do have another question. Are there any plans to have native assets on Entangle rather than wrapped as you guys at the current moment? So perhaps like a Thor chain model where you're able to trade with like native Bitcoin and things of that nature?
It depends on what you're specifically referring to with native assets, because I feel that words is used very interchangeably. I mean, native in general in the whole DeFi ecosystem. And so do you mean in bridging solutions, like, for example, Stargate is bridging authentic native USDC issued on each chain by Circle, and they're allowing a deposit withdrawal bridge? Is that what you're referring to?
Yes.
Yes. So through Entangle, you can create any kind of bridge, which is, I guess, there's only really two kind of bridges. I mean, each verified on their own way. So we externally verify, and we apply double validation, where the first validation is on top of Entangle blockchain, and then the second kind of threshold validation consensus is achieved on the external blockchain endpoint. And what kind of bridges we can do is essentially burn a mint. So you burn a token on chain A and you mint the equivalent token on chain B, which is the wrapped ERC20 bridge token model. And then you have also the Stargate model, which is the native asset lock and release model, where you lock an asset on chain A, and based on liquidity provided on chain B, an equivalent amount is released there. And these we can do as well, essentially, in order for us or any developer to launch these, really, if we're just talking integration-wise, which is maybe an interesting thing for you, is that they have to gain a certain amount of Entangle tokens. Then they have to go to the Gov module and deposit these, which gets burned. It's like a governance module. It's not like a DAO governance. It's just like a governance module inside the Entangle blockchain. And then any stakeholder, like validators, delegators, keepers, other developers can vote if that developer is allowed to host smart contracts on Entangle blockchain or not. Provided the developer actually gets access, which is most highly likely, I don't see why not, they get support smart contracts on Entangle blockchain. So these contracts will be called spotter smart contracts. This is where they pinpoint, for example, what kind of data they want to store in Entangle blockchain, how they process it, what kind of on-chain computation logics, and also external endpoints and validation consensus mechanics. And then they connect the various endpoints via, for example, chain A or chain B together through Entangle. Just like Layer 0 has ultralight nodes on each blockchain, Entangle has, the technical term is aggregator spotter smart contracts, but I'll just refer it to Entangle endpoints, where then keepers aggregate information, which then gets validated once again for authenticity, and which then triggers one or the other smart contract of a DAPP on each of those blockchains. But also, like Layer 0, maybe it's also interesting for some. I think the beauty of Layer 0 is simplicity for developers, how you can call any function essentially via their endpoints on another blockchain. The difference between us and them is we are not really, when you're a developer, you're not really calling a function on another blockchain. You're calling a function inside Entangle blockchain, which then redirects that to another blockchain in order to do transferable on-chain computation and a second validation on the Entangle blockchain and the relevant Entangle endpoint.
Thank you, man. Appreciate the long and descriptive answer. So where can people find out more about what you guys are building, and also really anything to do with Entangle and its developments?
So first things first, the website Entangle.fi, which is currently going a design overhaul. We're going to be a little bit more fancy from now on. And of course, then our Telegram and Discord channels and Twitter. We're going to also be much more active now with a BD and marketing campaign and really just trying to educate people. Then we also have some, for example, I don't know if you've seen LE5 DeFi, which are posting some great infographics about us. But if you really want to go down the rabbit hole, and I implore everyone to read the white paper. I know it's a long white paper. It's one of those long, tedious ones. I think it's 80 pages long. It's a bit longer than most projects with a lot of mathematics describing the algorithms which we employ. But I think those are great places, and we're always welcome for any questions. So if you ever have any things, oh, that doesn't really make sense, or I don't exactly understand that, please feel free to pop up in a Telegram or Discord chats. We're always there. We love a good grilling session, if anything, and we love to interact with anyone that has any interest to Entangle and what we're building.
Awesome, man. I guess I'll save my next batch of questions whenever we reconnect for the V2 testnet, man. Would love to get to know your guys' thoughts on things like Cosmos IBC and things like Bear Chain, and really see if those chains interest you guys and how you see moving out into that ecosystem. But we'll save that discussion for another time. Truly love what you guys are doing, and I really like the trend that's going on with the innovation side of DeFi and crypto, with omni-chain smart oracles, and also all things layer zero. So I want to thank you, Slava, for sticking around for an extra 10-15 minutes after Trissy and Faisal left. Thank you so much for taking the time to join us over here because Bitcoin. This AMA was truly informative, and I could not be more excited to see what you guys are developing. And also for our audience, if you're new to these spaces, my name's Wabi once again. And if you like this content, feel free to follow us and turn on bell notifications. And also go ahead and follow Entanglefy and turn on bell notifications so that you can be made aware of when these spaces go live. And just as an announcement for our next spaces for Crypto World Radio here on Because Bitcoin Twitter Spaces is going to be tomorrow, Thursday at 7 p.m. Eastern Time. We'll be not covering, we'll be having an AMA and general discussion with a few gentlemen that work for Shade Protocol, and also the Shade protocol handle itself, and potentially also have a secret network on board during the space. So make sure to tune into that. Thank you guys so much. Thank you once again, Slava. God bless you all. Take care. And you can catch a replay of the space on our YouTube channel in a couple of hours. And also here via Twitter. I see our spaces are being recorded with that little cute red button. And Premise, you guys start market checking like right now, right? Are you guys gonna merge?
No, we're not. No, not today. That was not the plan.
Okay.
I also want to thank everyone, and thank Because Bitcoin and King Wabi especially for being the host, and thank you everyone for attending today. It was a great pleasure to speak here, and we look forward to welcome you all in our community on Telegram and Discord and participating in our testnets. Great pleasure. Thank you so much again, everyone.
Bullish, man. Bullish. Appreciate you, man. Much love. Big love to all of you. Make sure to check out Market Check. Premise, is that going to be on YouTube or here on Twitter Spaces?
No, there's no market check today. Yeah, no market check today. We're just concluding. Yeah. But yeah,
Okay.
we'll be doing printing with Premise sometime later today. Y'all could wait for the announcement for that. We'll announce it from the Because of Bitcoin Twitter at least an hour, 2 hours before we do that.
Okay, no problem. All right, guys, take care. God bless you. Feel free to follow us here Because Bitcoin and also Entangle to catch up with everything that's going to be rolled out. All right, guys, take care. God bless.
The trading current is just math. It's just math. It has a 95.45% hit rate when we deviate outside of CP2 and CN2. All you had to do is recognize that 95% of the time when we get over here, under this blue line, we get some sort of mean reversion. So let's just assume you long right here. 95 out of 100 times, when I buy this, I'm going to get some sort of bounce. It's just math. Look what would have happened as we move up. Look at the bounce that came after. And now look where we are. If you had just blindly followed the current, you take all emotions out of it, you say, I'm going to trust the statisticians. You would have bought Dow Jones somewhere down here under 30,000, depending on how you want to measure it from absolute top to bottom, 20% move. We also have multi-time frame alerts. You don't even have to be at your computer on TradingView. You can ping your phone. Now, the current has some really awesome features, and I would urge you guys to join our Discord to get access to it. We give it away for free as a tool to the community. It's just math. There's really no need to overcomplicate things, not even in the slightest.